Hello everyone, and welcome back to another CRT video. In this one, we will focus on the concept of ranges, what they are, the different types, and how to trade them effectively. While some of you may already be familiar with the material covered here, and it might seem somewhat repetitive, my goal with these videos is to provide a comprehensive understanding of ranges and the turtle soup strategy. We'll dive into the details, ensuring that you have a solid grasp on how they function in trading. Once again, I do want to shout out Sham or Speculator for the video idea, and also Romeo for shedding light on CRT and turtle soup. Now let's get into it. Let's begin by introducing and defining the concept of ranges. I'll provide you with the most refined and relative definition I've developed. In general, a range refers to a market condition where the price fluctuates within a fixed boundary, typically between a specific high or low over a period of time. When the price consistently moves within these set limits, it's known as a range or a range-bound condition. This is what we refer to as a range. Some of you may already be familiar with this topic, but it is crucial to watch this entire video. Even if you do think that you know it all, this video will not only reinforce and refresh your fundamental understanding of ranges, but it will also clarify any lingering questions or confusion that you may have. You might have overlooked it, but a solid grasp of the basics is crucial in trading. Without a strong foundation, you won't be able to progress to more advanced levels, as these concepts are built upon the fundamentals. It's essential to revisit and reinforce your understanding of the basics before moving forward. So, when price oscillates within a fixed range between a high or a low over an extended period of time, it creates liquidity. This behavior is known as ranging conditions, or simply a range. The second key principle when dealing with ranges is to avoid trading within the middle. Focus on trading near the range's extremities, but only engage when these extremities have been purged, and they must be purged at a key time. If the buy-side liquidity of the range high is swept, that is your signal to sell. Conversely, if the sell-side liquidity near the range low is purged, your goal is to buy. While this approach may seem cliché, it is an essential concept to grasp for deeper understanding of market dynamics. So only buy below the range lows and sell above the range highs, and only trade at the extremities of the range. Do not trade near the middle. Let's now move forward to discuss what a typical range looks like. We have a defined range high and range low, with the price currently stuck between these two levels. The price hasn't made any decisive moves and remains confined within this range for an extended period. In these situations, it's best to avoid taking any positions. Instead, we wait for a clear break above or below the range extremities. Once that occurs, we can apply our respective entry models accordingly. Now, there are various types of ranges that can develop, so let's explore each one in detail. The first type that we will discuss is the typical range. While these ranges can be somewhat subjective due to the lack of clearly defined highs and lows, it's essential to understand their structure and dynamics. Typical ranges refer to price movements confined within a defined high or low, creating a bounded range. Understanding these ranges will aid in grasping other types of ranges. However, we won't focus on trading within typical ranges often, as the alternative ranges are derived by fundamental dynamics, which offer more strategic opportunities. Next, we have the second type of range, CRT or candle ranges. If you've been following me on Twitter or have watched any of my videos in this series, you're likely to already heard of them. These ranges are derived from specific higher timeframe candles that adhere to certain protocols, allowing us to use them as effective ranges on lower timeframes. These ranges are derived from specific higher timeframe candles that adhere to certain protocols, allowing us to use them as effective ranges on lower timeframes. CRT is both dynamic and objective thanks to its fixed and definitive highs and lows, which are determined by its specific opening and closing times. This is one of the highest probability ranges that you can use. Lastly, we have time ranges. Named this because they form at specific times of the day or the week. These ranges are time dependent and objective, with their extremes defined within precise time windows. The highest probability examples of this are the Asian session range, the central bank dealers range, and the highs and lows of Monday's daily CRT candle. These ranges are classified as time ranges because they are established at specific objective times. Now, let's explore some visual representations of each of the ranges we've just discussed. So the first type we discussed was the typical range. It consists of a high and a low, with the price oscillating between the two. This is the standard appearance of a typical range, though it's somewhat more subjective compared to CRT or time ranges. Second up, we have CRT ranges, which come in two forms: the 3-candle CRT and the inside bar CRT. I covered these extensively in a previous video if you'd like to dive deeper. Also, I have a full 30-page in-depth thread on my Twitter. It's my pinned tweet. So briefly, the 3-candle CRT involves the first candle setting the range, the second candle representing manipulation or a purge, and the third candle serving as the distribution candle, driving the price towards the opposing end of the range. On the other hand, the inside bar CRT is considered to have a much higher probability of success. You should identify these ranges in alignment with higher timeframes draw on liquidity, or only range trade them if they are positioned in the same direction as the higher timeframes draw on liquidity. CRT also has a lot of intricate protocols you must adhere to before choosing them, which has slightly been discussed in a previous video and will be further discussed in a later dedicated video. Lastly, let's look at an example of time ranges. In this chart, you'll notice specific time intervals at the bottom. We have 4 p.m. to 8 p.m. New York time, which represents the central bank's dealer range. During this period, the price typically consolidates within a range, making it a dynamic range known as the CBDR. Following that, from 8 p.m. to midnight New York time, we enter the Asian session range, also referred to by ICT as the Asian kill zone. Defining the highs and lows of these ranges is straightforward. Simply select the highest high and the lowest low formed within the specific time window. This will then establish your time range for that particular period. Here we have marked up the highs and lows of the Asian session range. And now we are waiting to enter a trade at the optimal time. Specifically, we're looking for one of these extremities to be purged during a key time. My preferred time being the London kill zone, which runs from 2 a.m. to 5 a.m. New York time. Another example of a time range is the Monday candle range. If this candle forms while testing a higher time frame key level, the high and low of the Monday's candle are treated as a CRT range in their own right. Additionally, since this range forms at a specific time, it also qualifies as a time range. So let's now cover how to effectively trade these ranges. So here are the objective rules to follow when trading ranges. First, avoid trading when price is in the middle of the range. Trading in this zone lacks a clear draw on liquidity and does not provide objective criteria for setting entries, stops, or targets. Instead, Focus on trading only when the price reaches the extremities of the range and it has been purged, ensuring a more defined and objective setup. The second protocol is to buy the breakout of the low of the range. This means that when the low of the price is purged or temporarily breached, you should then wait for your preferred entry model before placing a buy order. For the opposite side, we are selling the breakout or the purge of the high of the range. Once you get these purges at either side, you have an important protocol to follow for your profit-taking targets. Always take profits at the 50% equilibrium level of the range. This is because the mid-range often marks a point of reversal or expansion. So to cover yourself, make sure you always partial and take some profits once the 50% point is tapped. This protocol helps you to lower risk and increase your win rate. Another crucial rule is to wait for either side of the range to be purged at a key time. It's essential to trade only during high probability purges. As highlighted previously, optimal times for these purges are during the London kill zone, which is 2 a.m. to 5 a.m. New York time, or the New York kill zone, which is 7 a.m. to 10 a.m. New York time. These periods are the best times to watch for significant purges. Lastly, integrate CRT with your trading range. When observing the purge of your range, you'll often find a CRT setup present. These types of CRT are the highest probability and always work best, and by trading this CRT on the lower time frame, you can achieve a high probability entry provided you use the appropriate entry models. This doesn't only apply to one type of range. With all three that I've shown you, you can wait for a purge, and more likely than not, you will see a smaller CRT present above or below the purge, and you then trade it on the lower time frames. Now let me show you an easy visual representation of some examples on how to actually trade a range effectively. Here we have a typical range where the price remains within the highs or lows for a specific period without making any significant moves or purges. During these phases, you should avoid trading and instead wait for a purge to occur at a key time. Once a purge happens, apply your entry model with your initial target set at 50% of the range, and your second target is the draw on liquidity or the range high. Here is another example. This method of trading ranges is the most refined and objective. So you are first waiting for the extreme of the range to be purged at a specific key time, and second you are looking for an objective CRT at that key time. Usually, during the purge, the candle will be large, so it can be easily treated as a CRT. Then, you will trade this particular CRT on the lower time frame. Let's examine a real-time example. We're analysing the euro on the 15-minute time frame, focusing on price action from 2 weeks ago. You'll notice the CBDR time and the Asian session range time. Additionally, you can observe how the price action has developed within these crucial time periods. Next, we identify and mark the highest high and lowest low within the Asian session time range. We then wait for a price movement that purges these levels at a key time. If the price breaks these levels outside of a key time, you can still consider trading it, but be aware that the likelihood of success will be significantly lower. Always lower your risk if time is not an active protocol. The best thing to do, however, is wait for a purge at a key time and then wait for your entry model to trade it. So you can see here that we purged it on the London open candle right here, then it reversed to the opposing end of the range, which would have been our target. We then purged the range low at another key time, which is the New York Open. It then gave us our Model 1 OB entry and then expanded above to our draw on liquidity. Now, I hope you did enjoy this CRT video on how to actually trade a range. If you enjoyed, please leave a like, subscribe, and turn on those notifications so you don't miss our valuable trading content. I upload an indicator video every Wednesday and an ICT Concepts video every Sunday. I am currently in the middle of a sub-series on CRT. This is what I trade on a day-to-day basis, and if you would like to keep up to date with my trades, either follow me on Twitter or join my Telegram. Thanks for watching, happy trading, and see you in the next one.